Most investors believe they understand what happens to gold and silver when markets crash. But that belief is exactly what causes panic and costly mistakes. Because when stocks fall hard, gold and silver don't behave the way people expect. They don't surge instantly. They don't rush in to save portfolios on day one. And when that doesn't happen, doubt creeps in, gold drops, silver drops harder. And suddenly, people say the hedge failed. But that reaction misses something critical. Market crashes don't unfold in a single moment. They move in phases. And precious metals don't respond to fear the way headlines suggest. They respond to what comes after fear. The truth is, during the first shock of a crash, almost everything gets sold. Not because it's broken, but because cash becomes king. Liquidity matters more than logic. Survival matters more than strategy. This is where most people give up, right before the real story begins. Because once panic fades, once forced selling ends, once policymakers step in, gold and silver begin to move for reasons far more powerful than emotion. This video isn't about predictions, it's about patterns. What history reveals, and why the assets that disappoint early often matter most when the system is under stress. When markets begin to fall, logic is the first thing to disappear. Not gradually, not politely, it vanishes in minutes. In the opening moments of a stock market crash, investors don't analyze fundamentals. They don't rebalance portfolios. They don't ask what's undervalued. They ask one question. How fast can I get cash? This is phase one, and it has nothing to do with safety. It has everything to do with survival. Economists call it a liquidity shock. Former Federal Reserve Chairman Ben Bernanke described it as the moment when markets stop functioning. Not because assets are worthless, but because nobody can transact without stress. In simple terms, everyone rushes for the exit at the same time. Hedge funds face margin calls measured in hours. Banks tighten lending overnight. Institutions sell what they can, not what they want to. And here's the critical mistake most investors make. They assume gold and silver should rise immediately. History says otherwise. During the 2008 financial crisis, as Lehman collapsed and credit froze, gold didn't surge, it fell. Silver didn't wobble, it collapsed. From March to October 28, silver dropped over 50%. Gold fell nearly 30% from its peak. Not because they failed, but because they were liquid. Gold and silver trade globally. They can be sold instantly. That makes them useful in a crisis, but also vulnerable. In phase one, liquidity beats conviction. This behavior isn't theoretical, it's measurable. Market microstructure studies show that during volatility spikes, correlations across assets surge toward 1.0. Everything moves together. Stocks, bonds, commodities, metals. Diversification temporarily dies. Even Nobel laureate Hyman Minsky warned that during financial stress, systems shift from stability to panic-driven liquidation. That panic has a rhythm. First 72 hours, margin calls accelerate. Forced selling peaks. Day 4 to day 10. Volatility explodes. Prices overshoot fundamentals. This is the window where gold disappoints most investors, and where impatience does the most damage. Because phase one is not about value, it's about cash flow. It's about who needs money now versus who can wait. Most people can't. Retail investors sell because red numbers feel unbearable. Institutions sell because they're required to. Algorithms sell because volatility thresholds are breached. Gold gets caught in the crossfire. Silver suffers more. Why? Because silver isn't just money, it's industry. When markets crash, expectations for manufacturing, construction, and energy demand collapse instantly. Silver prices absorb that fear in real time. That's why silver falls harder, faster, more violently. And that's why phase one feels like betrayal. But here's the truth few ever say out loud. If gold and silver didn't fall in phase one, the system would already be broken beyond repair. This sell-off is the pressure release valve. And once it empties, everything changes. Because phase two doesn't belong to panic, it belongs to policy. And that's where the real story begins. When gold falls during a market crash, disappointment spreads faster than fear. Gold is supposed to protect you. That's the promise. That's the story repeated for decades. So when stocks collapse and gold drops with them, the reaction is instant. It failed, but that conclusion comes too early. Gold and silver don't fail first. Expectations do. The mistake? Assuming gold moves opposite stocks, day by day, headline by headline. It doesn't. Gold isn't an emergency brake, it's a structural stabilizer. And in the opening phase of a crash, structure hasn't broken yet, liquidity has. Sudden stress triggers what economists call a forced deleveraging cycle. Positions built over years unwind in days. Leverage snaps. It doesn't politely step aside. Data from the Bank for International Settlements shows before major crises, global leverage often exceeds 300% of GDP. When asset prices fall, leverage becomes toxic. Margin calls don't care about long-term value. They care about collateral. Now, So investors sell what's easiest: gold futures, silver ETFs, highly liquid positions, not because they want to, because they must. Gold often falls before central banks intervene. Ray Dalio calls this transition from normal market behavior to cash is everything. Silver is even more exposed. Half money, half industry. Expectations for factories, solar panels, electronics, construction evaporate in hours. In 2020, silver plunged over 30% in 3 weeks. Gold fell too, but less. Silver's volatility creates the illusion of failure. Gold's stability creates frustration. Both reactions are emotional. Neither is analytical. Then there's the US dollar. In crises, the dollar strengthens first. Not because it's strong, but because it's needed. Dollar-denominated debt exceeds $13 trillion worldwide. When stress rises, borrowers scramble for dollars. This surge pushes the dollar up, and gold and silver priced in dollars feel the pressure immediately. It's temporary, but it feels permanent. It convinces investors gold isn't working. That belief comes at a cost, because this phase, this uncomfortable window, is when the conditions for metals' future strength are being built. Rates haven't been cut yet. Money hasn't been injected yet. Balance sheets haven't expanded yet. Gold waits. It doesn't shine during tightening. And then, once pressure becomes unbearable, once liquidity stress threatens stability, policymakers act. That's the end of disappointment and the start of the reversal. But by then, most investors are gone. Phase 2 catches so many off guard. Every market crash has a breaking point. Not the moment prices fall, but the moment the system can no longer absorb the shock. That's when policy takes over. This is the turning point most investors miss, because it doesn't arrive with fireworks. It arrives with press releases, emergency meetings, late-night statements, carefully chosen words like stability and orderly markets. But behind those words is something far more powerful: intervention. Historically, when financial systems face collapse, governments and central banks follow a remarkably consistent playbook. Interest rates are cut fast. Liquidity facilities expand, quietly at first. Balance sheets grow, then explode. This isn't ideology, it's mechanics. Former Federal Reserve Chair Janet Yellen once explained it plainly. In a crisis, the cost of doing too little far exceeds the cost of doing too much. That philosophy defines Phase 3. In 2008, the Federal Reserve S balance sheet expanded from under $900 billion to over $2 trillion in just months. By 2011, it surpassed $2.8 trillion. In 2020, the response was faster and larger. Within weeks, the Fed injected trillions of dollars into the system. Rates were cut to near zero. Asset purchases went unlimited. This speed matters, because gold doesn't respond to fear. It responds to policy expectations, specifically real interest rates. Real rates are simple in theory: nominal interest rates minus inflation. When real rates fall towards zero or turn negative, the math changes. Holding cash becomes costly. Bonds lose appeal. Gold becomes competitive, despite offering no yield. Nobel laureate Paul Krugman has emphasized this repeatedly. When real rates are negative, non-yielding assets stop being a disadvantage. This is the moment gold begins to move, quietly at first. Often while stocks are still volatile. Often while headlines remain grim. Gold tends to bottom before equities, because it looks forward, not backward. It anticipates policy, not profits. Silver follows a different rhythm. During early intervention, silver often lags. Industrial demand is still weak. Confidence hasn't returned. But once stimulus turns into spending, infrastructure, energy, manufacturing, silver reacts with force. In 2009, after liquidity stabilized, silver began a rally that eventually carried it from under $9 to nearly $50. That move didn't happen during panic. It happened after policy rewired the system. This is why Phase 3 is misunderstood. Investors expect clarity before action. Markets move on expectation. By the time policies feel obvious, gold has already repriced. This creates a psychological trap. People wait for confirmation. Confirmation arrives late, and the window closes quietly, because policy response doesn't just stabilize markets. It changes the rules. Debt grows. Currencies weaken. Purchasing power erodes. And in that environment, gold stops looking like a relic. It starts looking like insurance. That's why Phase 3 isn't loud. It's subtle. But once it begins, there's no going back to the old system, and that realization sets the stage for what comes next. After policy response begins, the market enters a new phase. The panic has faded, the bleeding slows, but confidence has not returned. This is the space where gold moves first. Not explosively, not emotionally, but deliberately. Gold is a forward-looking asset. It doesn't wait for economic data to improve. It reacts to expectations. Specifically, expectations about money, debt, and trust. Once central banks suppress interest rates and flood markets with liquidity, gold senses the shift almost immediately. Not because growth is coming back, but because discipline is gone. Real interest rates begin to fall, sometimes below zero. Historically, this is gold's signal. Economist James Tobin once noted that when the opportunity cost of holding money declines, stores of value without yield regain relevance. Gold becomes attractive not because it pays you, but because alternatives don't. This is why gold often bottoms before stocks. During the aftermath of the 2008 crisis, gold turned upward months before equity markets stabilized. By the time the S&P 500 hit its bottom in March 2009, gold had already been quietly rising. Silver did not follow immediately. And that delay is critical. Silver behaves differently because it lives in two worlds. One foot in money, one foot in industry. Roughly 50% of silver demand comes from industrial use: electronics, solar panels, medical devices, infrastructure. When economies are still fragile, that demand stays weak. So silver hesitates. This hesitation frustrates investors. They expect silver to mirror gold. It doesn't. But when stimulus transforms into action, factories restart, governments spend, infrastructure projects launch, silver wakes up. And when it does, it moves fast. Because silver's market is small, the entire global silver market is worth a fraction of the gold market. That means marginal flows have outsized impact. In the years following 2009, silver didn't just recover, it surged, rising more than 400% from its lows. The same pattern appeared after 2020. Gold reached new highs by August. Silver lagged for months. Then, suddenly, it doubled. This isn't coincidence, it's structure. Gold reacts to policy signals. Silver reacts to economic response. Gold moves first, silver amplifies later. This dynamic explains why silver feels uncomfortable to hold during crisis. Its volatility is emotional, violent, unforgiving. But that volatility is also potential. Physics offers a useful metaphor. Gold behaves like a stabilizing mass, slow, dense, predictable. Silver behaves like a spring, compressed during stress, explosive when released. But timing matters. Investors who chase silver too early suffer. Those who abandon it too soon miss the move. Understanding the sequence changes behavior. It replaces impatience with structure, emotion with timing. Because when gold begins to rise quietly and silver refuses to follow, that silence is not failure, it's tension building. And when that tension breaks, silver doesn't whisper, it roars. And that roar defines the next phase of the cycle. In every global crisis, one currency behaves the same way. The US dollar rises, not because it's trusted, not because it's strong, but because it's needed. This is one of the most misunderstood forces in financial markets. When panic erupts, the world doesn't rush into safety. It rushes into liquidity. And liquidity speaks one language: dollars. More than 80% of global trade is settled in US dollars. Over $13 trillion in dollar-denominated debt exists outside the United States. When markets crack, that debt doesn't disappear. It tightens. Borrowers scramble to secure dollars to service obligations. Banks hoard reserves. Corporations draw down credit lines. The result is a global dollar squeeze. And when the dollar surges, gold and silver feel immediate pressure, because precious metals are priced in dollars. When the dollar strengthens, it mechanically pushes metal prices lower, even if nothing fundamental has changed. This is why gold often falls at the worst possible moment emotionally. It's not being rejected, it's being repriced. Economist Milton Friedman warned decades ago that currency demand spikes during crises create temporary distortions, not long-term trends. This phase is temporary, but it's powerful. In 2008, the US dollar index surged as global credit markets froze. Gold fell sharply in response. In March 2020, the pattern repeated. As markets collapsed, the dollar spiked to its strongest levels in years. Gold dipped, silver plunged. Again, people said the hedge failed. Again, they were early. Because dollar strength during crises is a symptom, not a cure. It reflects stress, and stress forces a response. When the dollar shortage becomes too severe, central banks intervene. Swap lines expand, liquidity facilities open, balance sheets inflate. In 2020, the Federal Reserve extended dollar swap lines to major central banks within days. Trillions were made available globally. This is the pivot. The moment the dollar's strength turns into weakness. As supply overwhelms demand, the dollar loses altitude. Real yields fall. Inflation expectations rise. This is when gold responds. Not to fear, but to dilution. Gold doesn't hedge volatility, it hedges currency debasement. Silver follows with leverage. As the dollar weakens, commodities reprice. Industrial demand recovers. Investment flows return. This transition doesn't happen overnight. It unfolds quietly. Dollar peaks often occur before market bottoms. By the time the dollar weakens visibly, gold has already begun moving. This creates another psychological trap. Investors wait for dollar weakness to confirm gold strength. By then, the move is underway. Understanding this sequence reframes everything. Dollar strength is not bearish for gold long term. It's a precursor, a pressure point, the calm before the release. Because once liquidity is restored, once dollars flood the system, the very force that crushed metals becomes their fuel. And that reversal sets the stage for the final phase, where patience stops being painful and starts being rewarded. There is one mistake that quietly destroys more returns than panic selling. It's not fear, it's timing. Most investors believe success comes from being right at the right moment, buying the bottom, selling the top. But history tells a different story, especially with gold and silver. Precious metals are not sprint assets. They are endurance assets. They don't reward precision. They reward positioning. This distinction matters more than most people realize. During crises, investors instinctively turn gold and silver into short-term trades. They expect immediate protection, immediate confirmation. When that doesn't happen, frustration builds, and positions get abandoned at exactly the wrong time. This is where psychology overwhelms structure. Behavioral economists like Daniel Kahneman have shown that humans feel losses twice as intensely as gains. When gold moves sideways for months, when silver remains volatile and uncomfortable, the emotional pressure becomes unbearable. So people exit, not because the thesis broke, but because patience ran out. Institutional investors think differently. Central banks don't trade gold, they allocate to it. They hold gold not for price action, but for resilience. According to World Gold Council data, central banks have been net buyers of gold during periods of geopolitical stress, currency instability, and post-crisis environments. They don't wait for perfect timing. They secure exposure, because gold's purpose is not to outperform every year. It's to perform when confidence in paper systems erodes. Silver follows a similar logic, but with more volatility. Silver is rarely accumulated quietly by institutions. It's accumulated violently by markets. That makes timing even harder. Silver often underperforms just long enough to exhaust investors. Then it moves in compressed bursts. Missing those bursts erases years of waiting. This is why allocation matters. Allocation removes emotion from decision-making. Instead of asking, "Is now the perfect time?" the allocator asks, "What role does this asset play if the system changes?" Gold's role is stability across regimes. Silver's role is asymmetric upside during monetary expansion. Neither role depends on perfect entries. They depend on presence. Historical data supports this. Studies on portfolio construction show that small, consistent allocations to gold reduce volatility and improve risk-adjusted returns across long time frames, even when gold underperforms periodically. Silver, though more volatile, enhances returns during inflationary and stimulus-driven cycles. The key is duration. Gold and silver punish impatience. They reward endurance. They move slowly, until they don't. And when they move, they often do so while sentiment is still skeptical. That's the final psychological hurdle. Buying when it feels boring, holding when it feels pointless, staying when nothing seems to be happening. Because the moment gold and silver feel obvious, they're usually already repriced. Allocation accepts uncertainty, timing fights it, and in a world defined by rising debt, recurring crises, and aggressive intervention, the investors who survive aren't the fastest. They're the ones who understood the role of what they held long before everyone else remembered why it mattered. If there's one thing history makes painfully clear, it's this. Markets don't break the way people expect. And protection doesn't arrive on the schedule headlines promise. Gold and silver rarely save you in the moment of fear. They save you after fear rewrites the rules. That's why understanding cycles matters more than predictions, why patience outperforms panic, and why the biggest gains often come when conviction is lowest. The question isn't whether the next shock will happen. History already answered that. The real question is this. Will you understand what you're looking at when it does? Or will you react the way most people always have? Too early, too late, or not at all? Because the investors who benefit aren't the loudest. They're the most prepared. If this breakdown changed the way you think about gold, silver, and market crashes, make sure you're subscribed. Not for hype, not for predictions, but for frameworks that help you stay calm when systems are stressed. Like the video if you value long-term thinking over short-term noise. Comment below, do you see gold as protection or patience? Turn on notifications because the next phase of this cycle doesn't announce itself. And in the next video, we'll go even deeper into timing windows, psychological traps, and the signals most investors miss right before metals move. Because when the system bends again, understanding will matter more than speed.